Hi, I'm Tim Quast, founder and CEO of Market Structure Edge, and now we're going to begin this process of teaching you the basics. And a core thing to remember is this simple acronym, BCD: broad market sentiment, context, divergence. We're going to talk about the B at the moment. Look on your screen here. This is the dashboard at Market Structure Edge, and notice broad market sentiment is in the navigation pane, and it's right above your dashboard that has all your portfolios. Click through that, and broad market sentiment is our gauge for knowing when we should have more money at work in the market and when we shouldn't. And it's very simple. See the green part of the graph? This is the algorithm that measures demand. It's an algorithm that looks at buying and selling by traders and investors in the S&P 500, and when it's rising, there's more buying than selling, and when it's falling, it's the reverse. And when that peaks, prices tend to stop rising. When it begins to fall, prices fall. Well, that helps us to know. The beginning point is to understand when your money is more or less at risk, and this is the starting point. Right below it is supply. Notice this, that when demand is rising and supply is falling in the broad market, this is the S&P 500 SPY, the market rises. And when they reverse and they start converging, we're going to talk about that, then the market falls. Very simple stuff.